Welcome to The Explainer. I want you to picture this. A 95-year-old man living in Omaha, Nebraska. He's still in the exact same house he bought way back in 1958 for about $31,500. He grabs breakfast at McDonald's, downs 5 Cokes a day, and oh, by the way, he happens to be worth roughly $150 billion. If you were to walk right up to Warren Buffett today and ask him what you should do with $10,000, you'd get a deeply fascinating answer. In fact, it's an answer that completely contradicts almost everything he personally did to become the absolute legend he is today.
It's honestly the ultimate financial paradox, right? The greatest stock picker in human history will look you dead in the eye and tell you with a totally straight face not to pick stocks. But then literally in the exact same breath, he'll tell you that if he had your 10 grand instead of his hundreds of billions, he could earn returns that would make Wall Street's absolute best hedge funds look like total amateurs. He's guaranteed a 50% return. Now, both of these statements are absolutely true, and understanding exactly why they're both true is worth way more than any hot stock tip you'll ever get. So today we're unpacking exactly which of these two answers actually belongs to you.
Okay, let's jump right into Section 1, the public answer, also known as the widow's trust.
So we're starting with the public answer. This is the incredibly boring, mass-back strategy that he literally wrote into his own legal will. But before we even talk about buying a single stock, Buffett would ask you an immediate, disqualifying question. Do you have credit card debt? Because listen, if part of your 10 grand is sitting right next to a balance charging you crazy high interest, the investing conversation is over before it even begins.
Back at the 2020 annual meeting, he tackled this head on. He said, "If I owed any money at 18%, the first thing I'd do with any money I had would be to pay it off." And then he dropped this incredibly humbling reality check. I don't know how to make 18%. I mean, just sit with that for a second. The guy who successfully compounded money at 20% a year for 6 decades, which is literally the best sustained track record in human history, is flat out telling us he cannot reliably beat your credit card's interest rate. Paying off a card charging 24% is a guaranteed, risk-free, tax-free 24% return. The debt absolutely eats first.
All right, so once that high-interest debt is gone, step 2 is cash you can actually reach. Buffett is obsessed with never being forced to sell at a bad time, which means you need a solid emergency fund. Luckily today, high-yield savings accounts and short-term treasuries are paying a really comfortable 4 to 5%. So your debts are handled, your emergency fund is parked. What happens to the rest? Well, here is the unbelievably simple portfolio he instructed his widow's trust to use. Just put 10% in short-term government bonds and 90% in a very low-cost S&P 500 index fund. Vanguard is his suggestion. And that is it. The man who built a $1 trillion company by picking individual stocks chose the most boring product in all of finance for the person he loves most.
And this brilliantly illustrates exactly why he made that choice. This wasn't just some theoretical advice. Buffett bet real money on this strategy. Back in 2008, he made a $500,000 wager against a hedge fund firm. He bet that a do-nothing Vanguard S&P 500 index fund would absolutely crush a hand-picked basket of elite hedge funds over a 10-year period. And the results? 10 years later, that do-nothing index fund had returned 125.8%. The hedge funds, which were equipped with literal armies of brilliant analysts and charging premium fees, averaged just 2.2% per year. The index fund absolutely lapped the professionals.
Let's actually run the math on your 10 grand to see why this is so powerful. The S&P 500 has historically returned about 10% a year on average. At that rate, your $10,000 becomes roughly $26,000 in 10 years. In 20 years, it grows to $67,000. In 30 years, it reaches $174,000. And if you just let it run for 40 years, you are looking at roughly $452,000, almost $500,000. And the total effort involved on your part was literally just clicking buy once and then going on with your life.
Moving right along to Section 2, the hidden wealth destroyers, or why we fail the math.
So you might be wondering, if the math is really that easy, why do we mess it up? Why does data from firms like Dalbar show average investors underperforming the market by 8 to 12 percentage points? Well, the biggest saboteur is our own behavior. Let's think about a 20-year timeline. If you put $10,000 in the S&P 500 in 2005 and just left it completely alone, you'd have about $71,750 by the end of 2024. But if you panicked and missed just the 10 best days in that entire 20-year stretch, you'd have only $32,871, less than half. And here is the truly cruel trap of the stock market. 7 of those 10 best days happen within 2 weeks of the 10 worst days. The market's best days hide right next to its absolute worst days.
almost perfectly designed to punish impatient investors who panic and sell.
And then, of course, we have fees, the absolute silent wealth destroyer. If your $10,000 investment grows for 30 years in a standard index fund charging just 0.03% in fees versus the exact same fund charging a 1% active management fee, you end up with an $18,000 gap. $18,000, nearly twice your original investment, just vanished simply for the privilege of paying a professional who is likely going to underperform anyway.
All right, Section 3, the 50% cheat code, Young Buffett's secret.
Now, what's really interesting about this is, if indexing is the holy grail, what about that other side of the paradox? Back in 1999, a reporter asked Buffett about his incredible early returns, and Buffett dropped a quote the index crowd rarely ever mentions. He said, "It's a huge structural advantage not to have a lot of money. I think I could make you 50% a year on $1 million. No, I know I could. I guarantee that." And just to prove he wasn't bluffing, he repeated this exact claim at age 93 during the 2024 annual meeting. If you compound $10,000 at 50% for 2 decades, it doesn't become a few hundred thousand, it becomes $33 million. That's not just a return, that is literally a cheat code.
So why on earth doesn't he just tell everyone to do that? Well, because pulling off 50% a year requires a totally different lifestyle. When Buffett was playing with small money, he wasn't sitting around looking at stock charts. His strategy was basically investigative journalism combined with a calculator. At age 20, he found a locked Geico building on a Saturday, banged on the door until a janitor finally let him in, and then interrogated an executive for 4 hours straight. He sat in a room and read 20,000 pages of tiny print in Moody's manuals. He literally drove farm to farm in rural Nebraska, buying forgotten paper stock certificates directly from farmers. That intense, deep value hunting is exactly what earned him 30% a year in his 20s.
He didn't lose his touch, He literally just ran out of small money. Today, Berkshire Hathaway is sitting on roughly $397 billion in cash and treasury bills. This introduces what we call the size penalty. When you're managing hundreds of billions of dollars, finding a tiny, mispriced $50 million company is completely useless to you. Even if it goes up 10 times in value, it wouldn't even register as a rounding error for Berkshire. He's literally too big to hunt the way he used to. And by the way, that massive mountain of cash tells us something pretty important about right now. Today's market is incredibly expensive. The Shiller P/E ratio, which measures how pricey stocks are compared to a decade of their earnings, is sitting at 40.7. That is the second highest reading in 140 years of recorded data. Berkshire's new CEO, Greg Abel, is hoarding cash right now because they absolutely refuse to overpay. Buffett even warned shareholders that Berkshire's stock will, at some point, fall 50% again. They're just waiting patiently for a crash. But remember, you are not Berkshire.
Let's move to Section 4. Which path is yours? Resolving the paradox.
So, how do we actually square this circle? The reality is, his answers aren't contradictory at all. They are the exact same philosophy applied to 2 vastly different types of people. The 50% path? That requires genuine obsession. You have to be deeply in love with the subject, not just the money. It means reading 10,000 pages of financial filings for fun. But the index path? That is for people with jobs, families, and hobbies. For the average person, which, let's be honest, statistically includes almost all of us, the index fund isn't some consolation prize. It's the winning ticket. It's the exact strategy Buffett trusts with his own family's wealth. So the crucial point here is the definitive 4-step playbook for your $10,000, straight from Omaha. Step 1, kill any 18% or high-interest debt immediately. Not even Buffett can beat that guaranteed return. Step 2, park a real emergency fund in a high-yield savings account, paying 4 to 5%. Step 3, put the rest into a low-cost S&P 500 index fund, maybe adding 10% in short-term treasuries if you want to mirror the widow's trust exactly. And step 4, do absolutely nothing. And that brings us to the ultimate question. You've got the exact map, drawn by the greatest investor who ever lived. The strategy is incredibly simple. But do you have the patience to do nothing? Can you stay the course when the market drops, when the news is screaming panic, or when your buddy pitches you the next big thing? The beautiful truth about the Buffett paradox is that the math doesn't require you to be brilliant. It just requires you to stay. Thanks for joining us, and we'll see you on the next Explainer.